But one of the oil industry experts who also, I know, is a keen aviator as well, Dan.
He is indeed a keen aviator. Steve, hello again to you. Well, let's continue the conversation live here on Squawk. Very pleased to say that Joe McMonigle joins us now. He's Secretary General of the IEF. Joe, always great to see you. Welcome.
Great to be here.
So let's go through what we're seeing right now in the market. How are you assessing the structure of the market as it stands, particularly after this latest Saudi move and the decision by Russia to deepen its production cuts?
Yeah, I think the Saudi cut, the extension of the July cuts to August was widely expected, I think, by the market. Really not much has changed since they made that first decision. I think the Russia announcement was more of a surprise, I think, to the market. Although I think it's been treated with a lot of skepticism because Russia has kind of had a spotty record in terms of compliance, and I don't think a lot of people are aware of this. I know you are because you follow this closely, but Russia stopped publicizing their production data, so it's very hard to verify what's going on in terms of production data. We estimate they're down February from about 400,000 barrels a day, but the exports have maintained very strong data because of the refinery maintenance season. And if the cut is exports, as was announced, it should be more easily tracked and verified by secondary sources. So, but the market treated it with skepticism, I think. But I think over time, if we see that those cuts are in place, I think that'll definitely have an impact. And I think the Saudi, even the cuts that were announced for in April and also the July cuts, you're going to start seeing that impacting inventories, which, that's real-time data for the markets. It's not, market sentiment, which I really think is the big weight on the oil market and of course, other sectors as well.
So walk us through when we're likely to see the impact of some of these measures hitting the market, because up until now, we've been promised a tightening in the second half. We're there. It hasn't seemed to have eventuated, at least for now. When are we actually going to see the market stabilizing to the point where we do see some kind of price momentum?
Yeah, well, I think there are very mixed messages on what's going on in the markets. I mean, I say it's a tale of two markets. I mean, the paper markets are really pricing in bad economic data and a recession, even though on the equity side, people are anticipating a soft landing. But on commodities, it's very pessimistic because of what they view as recessionary, bad economic times. But the real market fundamentals are quite strong. I mean, if you look at the different economies, they're exceeding expectations. The U.S. Demand for the final data month of April that was just released, demand for gasoline is 500,000 barrels a day. U.S. GDP in the first quarter was just revised up from 1% to 2%. India, sales of gasoline, diesel, and oil are at record levels. Even China, even though the manufacturing data has been mixed, imports and demand in China is near record levels. So I think there is a disconnect. China and India alone will amount to 2 million barrels per day of oil demand growth this year. So we are going to see a tightening in the second half of this year. Despite what OPEC is doing now, which I think is a lot to do with addressing this bad economic data that is impacting them, I think they showed, because they had this special April meeting, they're meeting twice a year now, but they had this special April decision. I think they've shown they're flexible. So if there is an issue with a big supply shock and we see prices get out of control, I think you could see them step in. And of course, they do have this end of the year meeting already scheduled. So I'm sure they'll be watching it very closely. But right now, they're reacting to something that's completely out of their control, and this is this bad economic and negative sentiment that's weighing on the market.
OPEC says it needs to act in order to create a stable price environment for the oil and gas investor. The IEF recently said we need an additional $5 trillion, almost $5 trillion worth of investment in upstream oil and gas in order to guarantee supplies and to basically prevent against and shield against market shocks.
Yeah.
The question is, where is the money going to come from, particularly in this environment when ESG is being highly scrutinized, and of course investors are watching this really closely. They expect some kind of climate return on these investments. So where's it going to come from?
Well, it has to come from the companies themselves. I mean, the NOCs are all investing in CapEx. Where it's not showing up is in the private sector. And there's a lot of reasons for that. The companies themselves are now trying to attract investors, so they're trying to return, have a better return on investment for investors. And that is actually getting some traction now. So you're seeing a lot of investors move now into the hydrocarbon sector, whereas they had shunned it previously mainly because of bad returns, but other reasons as well. Instead, investors looked at healthcare and tech, but now they're looking at traditional hydrocarbons, and you're seeing some companies now shift their investment decisions. Shell recently announced an increase in CapEx. We need a lot more of that. And it may seem odd for the head of an international energy organization to be talking about investment in hydrocarbons, but the reason I do is because I think it's important for the transition. Because if we want to keep the public engaged and supportive of the different policies and things, very transformational, difficult things we're going to be asking the public to do for the transition, we have to make sure we keep volatility and prices in check. Because if we don't, and the public makes that connection that this is because of the transition or climate policies, we lose public support, and then it's impossible to get it back, in my view. I know there are some people that don't care about that. They want to just impose these policies on the public. But I think it's important that we keep the public engaged, because I don't really care what your political ideology is. If the public starts to lose support on something as existential as energy prices, you're going to shift your views of policies. And so I just think it's so important that we keep oil prices and gas prices, natural gas prices in check. We keep the volatility, to a minimum. And by doing that, we can actually make a lot more progress, I think, on the transition. And by the way, keep these big energy companies economically healthy, because we need them to scale up all these new clean energy technologies. So this investment thing is important, not just for the here and now, but also for the long term, I think, as well.
So how do we make sure that these new investments are transition ready, though? Because investors also expect that too. And clearly, as we see new money going into renewables, or whether it's CCUS or other carbon abatement mechanisms, that's going to be a major investor focus. So how do we ensure that the industry is moving forward instead of moving backwards, as the critics would suggest it is?
Well, I think, look, any kind of natural gas infrastructure is really future hydrogen infrastructure. So I think on the natural gas side, and by the way, natural gas is really not even just a bridge. I think it's going to be a constant throughout the energy transition. We have to stop thinking about this from a Western European-centric view and think about the emerging economies that are going to need natural gas in order to make the transition. But we really need these big energy companies to focus on clean energy technologies, not renewables. There are utilities and other companies that can do renewables and do it better, I think, than the traditional hydrocarbon companies. We need these companies to step up on energy, clean energy R&D. CCUS is going to be critical, so critical to not just meeting our climate goals, but advancing the hydrogen economy. I mean, they go hand in hand together. And so the companies need to be focused on in clean energy R&D. They have some of the most amazing engineering and other technical talent to be able to do this. But they can't do it alone. They need governments to also be investing in clean energy technologies. There's so much money chasing deployment of renewables, and we need that to happen, because renewables has to grow exponentially to meet the climate goals. So we have to keep doing that. But if there's limited public resources, I'm not sure we should be focusing on deployment of renewables. Instead, in our view, it should be focused on clean energy technologies and developing them. Because until we have alternatives to oil and gas, we have to keep investing in oil and gas. And so we need to invest in commercialized and new modern clean energy technologies.